You just got your first K-1 and you're thinking, what in the world is this thing? Don't worry, you're not alone. In this video, what I'm going to do for you is walk you through a real K-1 tax form. It's actually from one of our RV park syndications, step by step. So if you're a passive investor and this is your first time actually getting one of these forms, this video is going to be exactly what you need. Look, I'm going to keep it very simple for you. And by the end of the video, you're going to know exactly what you're looking at. That's the main thing. And actually how it's going to benefit you at tax time. But before we jump in, very quick disclaimer. I'm not a CPA or a tax professional. I'm just sharing how I personally review a K-1 as a passive investor and as a general partner in real estate deals. Look, I know everybody's tax situation is different, so just make sure that you run your K-1 or K-1s by your CPA to see how it applies to you. Let's get going. Let's first answer the question, probably going through your mind, and when you get this, what in the world is a K-1 tax form, okay? This tax form, a K-1 tax form, is what you get when you invest in a partnership. It's funny how easy that is, but yet your CPA, or at least my original CPA, couldn't even explain that to me, okay? So this is what you get. You get the K-1 when you invest in a partnership, and that also includes real estate syndications like ours. So instead of a W-10 or a 1099, you get this K-1 because you own a piece of the deal. Now, this form is going to tell the IRS how much income. We'll number this 1, 2, and 3. So it's going to tell the IRS how much income, the losses, and then also what you really want, the tax deductions. Income, losses, and tax deductions that you're actually going to be responsible for based on your investment. Again, I'm going to be referencing a real estate syndication. Yours may be differently. And look, don't get stressed out. Your CPA knows how to use this. Well, let me back up. Your CPA should know how to use this. If they don't, then it's probably time to find a new one, especially if you're getting into real estate investing now and you want to continue in the future. So what I want to do is I want to take this one and I want to walk it through together so it actually makes sense for you. Let's get going. All right, so we have an example of a K-1 here on the screen. This was the one that I was holding up. And let's walk through it. The first thing I wanted to highlight down here, again, this is a scanned-in copy, so it may not be super clear. Right here it says Partners Capital Account Analysis. So right here it says capital contributed during the year. So this particular investor invested $100,000 during the year in our RV park syndication. All right. Then if you look at the line below that, the current year, the net income, the loss, and then when you look at it and it says negative $105,334, that sounds bad, right? But it's actually really good because it's mostly from the bonus depreciation that we get from performing cost segregation studies, which basically means you can write off a big chunk on your taxes with regards to this investment. All right. So even though the investment is performing and cash flowing, the IRS, because of this right here, sees it as a loss. Then you go down here and it says ending capital account. So the ending capital account is now negative $5,334. Again, this doesn't mean this particular person's money is gone. It's just how the tax accounting works. So if this was your situation, you're still going to get the cash flow and the profits. It just looks like a loss on paper. Now let's move over here to this side where the box 1, ordinary business income, is 0. That's typically 0 or blank. That's normal for syndications. Now, if you drop down right here to 2, this is the net rental real estate income loss. So the negative $105,920. Again, this is a big number to pay attention to because it shows your tax loss from the investment. Now, if you qualify, you actually may be able to use this number, depending on your tax situation, to reduce your taxable income. That's the beauty of real estate. Now, if we drop down here to box 5, interest income, $586. You may owe taxes on this small amount of interest from either from reserves or other sources. Now let's skip over here where there's other information, 20A, that 586, again, this just repeats this interest income. In the $4,957, this shows you your share of the loan that the partnership took out, the non-recourse debt. Okay, so this is used by your CPA. Code AG, the $12,292, this is your portion of the depreciation. This is the good stuff, okay? This is what allows us to show that big loss while we're still getting paid, all right? So I'm not just gonna stop there. Let me basically break this down, what all of this means to you, okay? If this is your situation, again, right here, you invested $100,000. It shows that you have a paper loss of $105,920. You also got $12,292 of depreciation right here allocated to you, box 20 AG. You still earn cash flow during the year. So Jeff, what exactly is happening? So it's all about how real estate benefits work, okay? So let's break this down even further. All right, so remember, all of this I know is probably confusing to you. So let's go back to the whiteboard and highlight what this means and what it can mean for you in different tax situations. Again, I'm not an accountant, check with yours. I'm just giving you what I've learned from not only teaching this, but from my accountant. But again, everybody's tax situation is different, okay? So remember, we had the $105,920 loss. Remember, this isn't, don't freak out, this isn't from your investment, the property losing money. It's only, remember that non-cash expense called depreciation, all right? Again, that means that the IRS lets us write off part of the building's value every single year. Now, our actual syndication group, we use something called bonus depreciation to actually accelerate that. So you can actually show a loss on a paper, again, even if you actually make money, which is great. Now, let's break this down for you regarding your situation. So if you're not filing as a real estate professional, which probably you're not, and the majority of our passive investors are not. So we'll put, so if you are not filing rep status, all right, this 105,920, that is called, we'll just put it right here, that is called a passive loss. Passive loss. And even though the word loss, again, may sound bad, it's actually one of the biggest tax benefits of real estate investing. So, all right, Jeff, I've got 106 grand passive loss. What can I do with it? All right. Well, it can offset other, and here's the key word, passive. So you have passive here and you have passive here. It can offset other passive income, such as rental income from your own real estate, maybe that you own, distributions from other syndications or real estate funds, any type of maybe profits from mobile home parks, RV parks, storage units, anything like that maybe you're invested with us or you're invested with another group as a limited partner. If you have income from ATM funds, oil and gas partnerships, or now there is some certain private equity deals, but as long as that you're considered passive. Okay. Again, this is something to get your CPA involved with, but those are just some of the things that you can use this $106,000 loss to help offset other passive income. Passive losses offset passive income. Passive losses offset passive income. If you don't have any passive income this year and you're like, oh gosh, it's a waste, no problem. This loss carries forward indefinitely. So whenever you do have passive income next year or maybe 3 years later or whatever, or even when this property eventually sells, you can use it to offset that income later. So in essence is, just because you can't use it, all of it or some of it or any of it this year, it's still going to roll forward for you to use. But here's what passive losses cannot offset. Again, unless you qualify as a real estate professional. The number one question that people say is, Jeff, if I invest in this RV park or mobile home park syndication or any syndication, I'm trying to find something that's going to offset my W-2 income, my paycheck from my job. I'm a doctor, I'm a dentist, I'm an attorney, whatever. And I want to invest in these things. Well, it doesn't work like that unless you're a real estate professional. So the losses will not offset your W-2 income. They're not going to offset your 1099 or your contractor income. It's not going to offset any active business income, again, like your dental or medical practice. It's not going to offset stock dividends or gains from selling stocks. It's not going to offset crypto profits. It's not going to offset interest income from savings accounts, from bonds or CDs. And it's also not going to offset qualified dividends from brokerage accounts. Okay, so while it won't reduce your tax bill from your day job or from your crypto portfolio, it still can become very powerful over time, especially as you're going to be hopefully shifting the brux of your income from active income, relying on active income, to now we're going to be shifting over to passive income. Right now, your active income's up here and your taxes are up here. But once we start making passive income, as it grows, there's a big gap. Your taxes are here. So even as it grows, it's not like the active income. As it grows, the taxes follow it. There's not much of a gap. Okay. Now, and so even if this is just your first investment, you get your K-1, if this is just your first investment, these losses can literally start stacking up and moving forward can become a major tax shield when you actually, if you hit like a big liquidity event or a sale or something like that. So let me give you an example. Let's say that you're in this situation and you also invested in another syndication, okay, same year, all right? And this other syndication, you made $20,000 in passive income. Maybe you have multiple syndications and total you get 20 grand, okay? Your 105,920 loss can fully offset that. So that means you pay zero tax. Then you still have what, $85,000 and some change and passive losses left to use it later. Okay. Remember, all of this was if you're not filing real estate professional status. So what if you are filing real estate professional status? Well, let's check that out. So right here, we're going to say you are filing reps. I've got plenty of videos and articles on that and what it entails. But this is where it gets really, really powerful. So if you or your spouse qualify, and typically if you're a doctor or dentist, you're a full-time professional, your non-working or part-time working spouse is usually the one that if you're going to try to qualify, they're the ones going to do it, because you have to either work, you have to work a certain amount of hours, 750 hours managing your property. And that comes out to being about 15 hours a week. Okay. So if you or your spouse qualify as a real estate professional, you may be able to use that 105,920 to offset your, so this may be used to offset your active income. That, my friend, is the game changer. Active income like W-2 income or 1099 income or income from your dental practice. All right. Here's an example. You're a dentist. You're trucking along making $400,000 a year. All right. Good money. And let's say your spouse maybe just works part-time in your office or something, but she qualifies as a real estate professional, again, under the IRS rules. So you could potentially take the 105,920 loss. Remember, before it was only a passive loss. You could potentially take that loss to reduce your $400,000 taxable income. So now when you subtract the two, when you subtract 105,920 from this, so now you're left with $294,000, $294,080. Okay. That's a potential six-figure deduction from just one investment. And again, it depends on your tax bracket. But something like this, just this right here, this could potentially save you around $40,000 in taxes just because of the way that you're filing. And again, you still are a partner in this syndication. So that means you're still earning cash flow the entire time, and yet you still own a share of the deal, but yet you're getting these unbelievable tax benefits, both from the syndication and offsetting your W-2 income. So whether you can use this loss this year or carry it forward later, this is exactly why the wealthy invest in real estate. It's one of the only strategies that's going to give you passive income. It's going to give you ownership in real assets, and it's going to give you huge tax advantages. You don't get this from stocks, and you certainly don't get this from mutual funds. This is what we mean when we say, don't just make money, learn how to keep it. Now, I've talked a lot about syndications and passive income, that sort of thing. And if you want to learn more about how I'm personally using it, passive income, to retire early, do yourself a favor. Watch this next video.